Howdy, Jacob here. Today we're looking at Sterling Infrastructure in the construction and engineering industry. 3.5 billion market cap, 3.25 billion enterprise value. Their growth has been pretty impressive, over doubling of the last 10 years from 672 million in revenue to almost 2 billion in revenue, averaging low single digit year-over-year revenue growth. Gross margin was extraordinarily low at 4.8% with a negative operating margin to now 17% gross margin, still very low, 10% operating margin, but a much improved margin and expansive enough to where the return on invested capital is double digits. Income statement, so no R&D, but they've really been able to increase revenue a lot more than cost of goods sold and sales general and admin, to where their operating profit is something. I mean, it's not, sub 10% is still pretty small. I don't know a whole lot of companies in the construction engineering industry, so I don't have that immediate reaction of margin, but it does seem a bit low to me compared to just the average business. But they do provide infrastructure, transportation, and building solutions. When I hear transportation, 5 to 10% does make sense to me. So not really confused by the margin, but glad that it's been going up along with their revenue. 472 million cash on hand, 27 million short-term debt, 315 million long-term debt. So they still have enough cash on hand to write off all their interest-bearing debt from short-term, long-term capital leases. They have more cash than that on hand. The cash flow statement shows a massive increase of free cash flow, and capital expenditure is definitely growing, but free cash flow going much more. So their CapEx has grown from low single digits to $60 million, and it looks like through acquisitions, they made some strategic acquisitions. It does look like every time they make an acquisition, free cash flow does grow. Cash from operations grows more than capital expenditures, meaning that they're very likely making strategic acquisitions to make their company more efficient, increasing bottom line. So their other use of cash is really just debt reduction and acquisition. So that's going to be our form of capital allocation as we make our projections here. So on the revenue growth side, they're bigger than they were 10 years ago, so it's going to be hard to grow at double digit. But I think with acquisitions, probably reasonable to get 8% return. If they're able to keep these high margins and be really good at acquiring businesses, that can also incur a premium. Mostly I don't incur premiums for acquisition companies because it hits the top line, not as much the bottom line. And if this company is increasing revenue 100% over 5 years, but increasing earnings per share and free cash flow double that, that is a very strategic acquisition, and one that I think if they're able to continue doing, creates premium for them. So I think 18 might be too much. Let's do 17 because it is still low margin business, but I do want them to have a premium above market average due to possibility for higher returns on invested capital, possibility for greater growth, greater efficiencies, but dampening it a tad because their margins are as low as they are. And even gross margins not extraordinarily high. So if you had an 80% gross margin with a 10% operating margin, obviously you could see ways for them to become more efficient and increase that bottom line a lot faster. But with a gross margin 17%, I don't see them increasing operating margin that high. So they have been increasing it substantially. I might be low here, but I do want to do a bit of a range just to see where those numbers are coming out at. And share change, not really any shares repurchased, not much stock-based compensation in relation to market cap. Maybe I'll increase it 0.5%. And so with my assumptions, I'm saying the company's stock price needs to fall a little bit more than in half to get to the return we're looking for here. It's a different business than what I'm used to. Like, the margins are a bit lower than what I like, and I don't like acquisitions. So two big things that I don't like, but they're extraordinarily well with their acquisitions historically. So if they're able to keep that up, I think that definitely deserves some sort of margin. What that is, for me, those low margins kind of still kind of still daunt me, and I see them in the back of my head. That's why at 17, I just put a somewhat premium over historical averages. But I do think that I'm comfortable with these assumptions, and so I'll be waiting a little bit more for it to get to a more attractive price. But I hope you enjoy the video, and have a great rest of your day. Thank you.